Hey, it's Jim, and this is level 1 of the CFA program, the topic on fixed income, and the learning module on interest rate risk and return. We've had some good conversations about return going all the way back to our time value of money learning module, but inside of these first fixed incomes, we talked about return. We've kind of danced around the concept of interest rate risk, and make no mistake, the emphasis in this learning module is interest rate risk. There are essentially two components to interest rate risk. You'll see that as we go through the learning outcome statements. Notice that there are action words that sound like calculate. So make sure you have your financial calculator handy. But I promise you, the good news in that first LOS is that you already know how to do this. So it's not going to be too terribly difficult, but we're going to apply it to investments in fixed rate securities. The third LOS, you haven't seen before. We're going to go ahead and calculate Macaulay duration. We'll show you an Excel spreadsheet, but then I'll also show you kind of a shortcut formula. And then that middle LOS is probably a source of lots and lots of good exam questions. The relationship between and among holding period, duration, and investment horizon. So let me begin with an example that I had my investments class complete here just recently. I gave them a 15-year bond, and that bond had a 10% coupon rate. The duration of this bond was 9 years. Now, let me just introduce this concept of duration. It is a measure of interest rate risk. That's important to know. But I want you to think of it as just kind of like a weighted average time to maturity. Now, I'll build on that as we go through this learning module recording, but I want to tell you about the assignment I gave my students so you can really grasp this even before we start in on the slides. So what I told the students, I said, since this duration is 9 years, let's go ahead and let's reinvest our coupons for 9 years and see what happens. So we got out our financial calculator. We put 100 in for payment. We put 1,000 in for future value. We put 9 in for I. And I said, let's just reinvest at the current yield to maturity, which was 10%. This is a bond that sells at its par value. So you do all that stuff and you get around $1,400. I'm rounding there if you're following along in your financial calculator. So those reinvested coupons, their future value over 9 years, which is the duration of this bond, $1,400. And then I said to him, hey, let's sell the bond today. So in 9 years, there's 6 years remaining on the bond. So we got out our financial calculator in Excel. And we entered those inputs. And since it was a bond that sells at par value, we knew that we were going to get $1,000. So you add the future selling price of the bond, $1,000 in year 9, to the future value of those reinvested coupons, which is $1,400, and you get about $2,400. So I want you to think about this. After 9 years, if you bought this bond today for $1,000, you would have $2,400 at the end of 9 years. Okay, that's important. So then I said to them, hey, suppose that we reinvest at a higher rate during those first 9 years. Let's pick 10.5%. So they all immediately said, well, Jim, we know what's going to happen. That future value is going to be higher. And of course it is higher. It was more than $1,400. But then they said, wait a minute, Jim, when we sell that bond at the end of year 9, since the yield went up, we're going to sell the bond for less than $1,000. And I said to them, boy, you guys are paying attention to me in class. So here's the really, really cool thing. When you sum the higher future value of the coupon payments to the lower future selling price, guess what you get? You get the same $2,400. So we quickly did 9.75%, 9.5%, 11%. No matter what we did, we got $2,400. Imagine how cool that is. If you buy a bond today and you know that at a certain time in the future, the bond's duration, you know what you're going to have at that future date. Imagine how much better of a financial manager you can be. That pretty much summarizes all the stuff that we're going to do inside of this learning module. Notice investment horizon in that second LOS. The investment horizon in my example was just 9 years. If you match the investment horizon to the duration of the bond, you immunize the bond against interest rate risk. Man, this is really, really cool stuff. So hopefully I can convince you of all that as we go through this relatively short learning module. All right, so what do? We already know this. What are the sources of return? We get the coupons and we reinvest those coupons. We get the principal payment at maturity. Now, if we hold the bond until it matures, like in my example with my students, we know we were going to get that $1,000 back at the end of 15 years. But if we sell it before 15 years, we're going to either generate a capital gain or a capital loss, depending what happens to market rates of return or the yields on that bond. So there are the sources. This is a really good exam question. Hopefully it's a simple answer for you guys. All right, we've seen this kind of stuff before, right? Discount bonds. These are bonds that sell below their par value. Premium bonds sell above their par value. Let's go back to our financial statement analysis learning modules where we're a corporation and we issue a bond and we issue it at less than its par value or more than its par value. Well, that premium or that discount, that has to be amortized over the life of the bond so that at the end of the life of the bond, you have that $1,000 or whatever that total par value, means. Now, I use the term yield to maturity. We've talked about this in previous learning modules. Yield to maturity on the bond. This is how I explain it to my students, and I've said this in other learning module recordings as well, is that the executives or a government official comes to the bondholders and said, hey, I need a bunch of money. Maybe it's $500 million, maybe it's $1 billion. And the bondholders say, what are you going to do with our money? And the executives say, oh, we have a positive and net present value project, or government officials say we need to finance our budget deficit, we'll pay you coupon, whatever that is. And so the bondholders, what they do is they say to the executives or the government officials, here's our money, we'll buy these bonds, but, and they wag their fingers, they say, but you better pay us the yield to maturity on the bond. And so that yield to maturity on the bond is really the interest rate on the loan. It's really the return that bondholders are requiring or demanding for providing capital to the corporation or to the government entity. Now, look down at the bottom. This is super important. Great exam question. If you buy a bond today, like my original example with my students that had a 10% yield to maturity and you bought it for $1,000 and you held that until its maturity date of 15 years, then you will have earned that 10%. So notice what we say there. The yield to maturity reflects the actual return if the bond is held to maturity, if there is no default, and if all those coupons are reinvested at that yield to maturity. That's the example that I was giving you and my students when we reinvested first at 10%, then at 10.5%, and then 9.75, whatever those numbers might be. So here's the slide here that I was telling you about earlier. So what is interest rate risk? It has two components. It has what's known as reinvestment rate risk. So of course, when reinvestment rates increase, when we reinvest those coupons, we're going to have a higher future value. That makes perfect sense. But, and this was an important point in my student example, if interest rates go up, if that yield goes up, and we sell the bond, in my example, it was in year 9, we're going to sell the bond for a lower price. So interest rate risk has two components, the reinvested coupons and then price risk. The learning module also calls it market price risk. So look at that bottom box there. Investment horizon is crucial for assessing interest rate risk. What did I say just a minute ago? And I'm going to say this in a future slide here in just a second. Duration is a measure of interest rate risk. I'm going to repeat that. Duration is a measure of interest rate risk. And then I'm going to put in parentheses, and convexity. We'll talk about convexity some other day. Here are a little bit more details about the two components of interest rate risk. So take a look at reinvestment risk, the risk of not matching the bond's yield to maturity when reinvesting. What did I say in my student example? It could either be a little bit higher than 10%, a little bit lower than 10%. Longer bond maturities, they increase reinvestment rate risk, of course, because instead of, what was my example, 15 years, if you have a 50-year bond, well, that sounds an awful lot like that's got to be higher reinvestment risk. This next one is an interesting here. Higher coupon rates increase reinvestment risk. I would know that for the exam. It's not nearly as intuitive as you might think. You might think like, hey, you know what? If I get $120 versus $100 a year, I have more to reinvest. Therefore, I ought to have more of a future value, whether interest rates go up or go down. But the notion here, and this is not very well explained in the learning module, and in fact, it's not really very well explained anywhere else. But the idea is that if you have higher coupon payments, that you may not be able to reinvest those at a higher interest rate if yields go up. And that's probably true if yields go down as well. So I would just remember that and pretty much forget about the intuition behind it. Zero coupon bonds, of course, they pay a 0% coupon rate, which means the bondholder receives $0 in interest, so there are no dollars to reinvest, which means there can't be any reinvestment rate risk. Now, the other component, market risk, notice we put price risk in here, as this simply illustrates the inverse relationship between yields and prices. So if you sell the bond before it matures, you're going to probably not sell it at the exact same price that you bought it. And clearly, if you bought it at par value, you're probably not going to be able to sell it at its par value. So you're going to sell it at either a premium or a discount, which means you'll either have a capital gain or a capital loss. So remember, price is just the sensitivity. Price risk is the sensitivity in bond price due to changes in yields. Now look at the tip we have over on the bottom right, is that in general, we can say this in general, reinvestment and market risks offset each other. Now that was true in my original example when we set the investment horizon, 9 years, to the duration of the bond. What term did I use earlier? The bond was immunized, and that works if you immunize a bond portfolio. Now, it's not perfect, it doesn't work all the time. In fact, I'll go ahead and give you a heads up here. It only works when there is a parallel shift in the yield curve. Didn't we just spend a whole great learning module on spot curves and par curves and forward curves? So imagine a parallel shift upward or a parallel shift downward, then that immunization works. But in general, reinvestment and market risks offset each other, but not always perfectly. All right, let's go ahead and get our calculator out here and do some calculations. Remember that very first day of time value of money, what did we talk about? We talked about a holding period return, and that's pretty much what we're doing here. However, we're going to add that concept of a geometric return where we consider the compounding effect. The coupons are reinvested, and then the interest on the coupons, they get reinvested, right? So look at that top orange point. It reflects, of course, the geometric return, which is an internal rate of return. Look at the blue box there, total return versus that bond purchase price. So look at the formula. There's our return. It's going to be equal to, well, what did I teach you back in time value money? It's essentially, and I teach you this in all sorts of things. Calculating a return is essentially just an F over P minus 1. Future value over present value minus 1. Now we need to make some adjustments here, of course. So there we have future value in the numerator. So that future value, that's the future value of those reinvested coupons that I gave you that example in my 15-year bond at the beginning of this slide deck. So we reinvest those coupons, and then we're going to add the sale price or the redemption amount, whatever that turns out to be. So that's exactly what I was saying earlier. What was that future value? I said it was about $1,400, right? And then when we sold the bond at its par value, we added $1,000. So think about calculating this return. What do we have? $1,400 plus $2,400 divided by the present value. That was the purchase price of the bond, which was $1,000 in our example. And then, of course, we need to adjust that over time. Right, that was that was a 9-year window, so we would have to raise that to the 1/9. We need to chop it up into its 9 parts, and you might think we just want to divide by 9 inside of those parentheses, but that would ignore compounding. So to consider compounding, we raise it to the 1/9. Here the formula is 1 over uppercase T, and there's our minus 1. I bet we can come up with a really good example here. You ready? 5-year bond, 8% coupon, sells at $85 out of 100 in par value. If the bond is held to maturity, then all we really need to do is compute the yield to maturity on our financial calculator. This is nothing more than solving for the interest rate, which we did back in time value of money. So we have an N of 5, we have a payment of 8, right? 8% of 100 is $8. We have a future value of 100. There's our par value. Now, in my example with my students, I was just assuming a $1,000 par value. So on the exam, the Institute will probably tell you whether assume $100 or $1,000. And then notice the present value, which is the price of the bond, has a minus sign in front of it. That reflects a cash outflow, right? We have to reach into our pocket, take out $85, and we're paying someone $85 to own that bond. So make sure you make present value negative. And if you hit the I button, you get 12.18%. So there's the yield to maturity on the bond. If the bondholder holds this for 5 years, then the return on the bond will be 12.8%. Now you can do this a different way, and this is what the Institute wants you to do back here in that purple formula. We can say something like, all right, let's suppose that we reinvest those coupons at the 12.18%. So if we compute that future value, we get the $51. Now, what the Institute wants you to do is look at that red diamond point down there. What they want you to do is sum from I equals 1 to 5, take the 8 times the 1.1218, and then raise that to the 5 minus the I. So you're going to raise it to the 4th power and the 3rd power and the 3rd power and the 2nd power and the 1st power and the 0 power. Well, you could get a migraine thinking about all that. Or you could just, what we've done in parentheses there, get out your financial calculator and solve for the future value. So that's 51. And that's similar to the $1,400 that I gave you at the beginning of this recording. My advice is you have your financial calculator right there. You might as well go ahead and use it on the exam. So then the horizon yield, so let me go ahead back here. What do we say? A future value of the coupons plus the price. There we go. So 51 plus 100 divided by the purchase price of 85, raise it to the 1 over 5. And lo and behold, there you go. You get the 12.18%. So my advice on the exam is to do this in the shortest cut possible, and that means using your financial calculator. Now, let's go ahead and dive into what what was that number? 12.18%. What does that mean? So that total return expected from holding the bond over a specific period, that horizon yield. Like, for example, we could have said, hey, let's go ahead and sell this bond after 4 years. And we would have had to gone through that example that I did at the beginning of this learning module. However, we'd still get some return down there in that bottom box. So look at the top right box. This is influenced. This horizon yield is influenced by the coupon payments and that bond price change, which is why I went through that example at the beginning. All right, you ready? Investment horizon, the period investor plans to hold a bond. So this is what you might think. You might think that if you have a 9-year horizon, that you might want to buy a 9-year bond. But if this is a coupon paying bond, the duration on that 9-year bond is going to be 5 or 6 or 7, depending on a lot of different factors. And so the idea then is at the end of 9 years, if you hold a 9-year bond, you don't know what you're going to get. Do you see this concept of immunization, how we're managing interest rate risk? So the relationship between this Macaulay duration measure will determine the bond's main source of interest rate risk. Is it the reinvestment or is it the price risk? Now here's a concept here that you'll need to know for definitions, this thing called a duration gap. It's really the difference between a bond's Macaulay duration and the investor's investment horizon. All right, so duration gap. What did I say earlier? That if, in my example, our investment horizon was 9 years and the duration was 9 years, which it was, then that duration gap will be 0 and the bond is immunized. But you can have a negative gap or you can have a positive gap. And now this is what I'm saying to you as good wealth managers, as good financial analysts, is that when you have a client that comes to you and says, hey, I want to build a swimming pool in my backyard 9 years from today, what bond should I invest in? And you're going to say, well, a 9-year coupon paying bond is not going to do it because we don't know what that future value is going to be. But if we pick Jim's 15-year bond that has a duration of 9 years, then we know at the end of 9 years, if we have parallel shifts in the yield curve, that we're going to have, what was that number I had, $2,400. We know we're going to have $2,400. So you buy however many bonds that you need to build a $50,000 swimming pool in the backyard. So as good wealth managers, we shouldn't have a negative gap. We shouldn't have a positive gap. Our bond portfolio should be immunized. However, on the exam, these are great questions. So if you have a negative gap, then you're mostly worried about reinvestment risk. If you have a positive gap, then you have your primary concern is going to be price risk. Make sure you know that's really, really great exam question. All right, what did I say earlier? I said that this concept of duration, it's a measure of interest rate risk. That's super important to remember. And it's a weighted average time to maturity. But it's also some other things. So look in the middle there, we have the dollar sign, weighted average time until the bond's cash flows are received. All right, so that's what I was telling you about the $2,400 at the end of year 9. That 9 years, look at the very bottom, it helps in understanding the balance between reinvestment and market price risk, right? It's almost like marginal cost, marginal benefits. Almost, but not completely accurate. But this top one up there, notice we put this in a nice little heart. So we love this one here. What did I say? Duration is a measure of interest rate risk. So in particular, Macaulay duration is a measure of a bond's sensitivity to interest rate changes. So here's the thing. If you have a 50-year bond and you have a 5-year bond, and let's just suppose that both of them sell for their par value today. Well, if yields go up, this is bad news for both bonds. But I promise you, if you do the math and yields go up by just a little bit, the 5-year bond is going to lose this much in value. The 50-year bond is going to lose this much in value. So there's no way that you want to hold on to a 50-year bond if you think that interest rates are going to rise, because the bond price is going to fall dramatically. So duration, in my example, is 9 years. It's a measure of sensitivity to interest rate risk. Longer term bonds have greater interest rate risk. Shorter term bonds have lower interest rate risk. Those are really, really great exam questions. Now, the LOS asks us to calculate the Macaulay duration. And so what I could do is I could go through the steps that the Institute shows you in this learning module, all those different colored boxes there. And by the middle or the end of those, your eyes might be crossing and you might be thinking, wait a minute, what is all that stuff? So why don't we just go ahead and show you an Excel spreadsheet. So there's the formula for Macaulay duration. So this is cool, right? There's that thing right there is a mathematical summation of this flow chart that we have over here on the right-hand side of this particular slide. But let's go ahead and do this, right? This is way more interesting than those steps from before. All right, suppose we have 10-year bond, 8% annual coupon, 8.5% yield to maturity. So what do we know right off the bat? The yield to maturity is higher than the coupon rate. I taught you this in a previous learning module. That must mean that the bond will sell at a discount. So what we're going to do here inside of this duration calculation is go ahead and compute the price of this bond, and then we're going to compute the weighted average time to maturity. All right, so imagine this as being an Excel spreadsheet. What we're going to do is we've got periods 1, 2, 3, 4, 5, all the way down to 10, all right? And we have time, and we have 1, 2, 3, time to receipt. We're going to receive our annual coupon of 8, right? So we have 8 in year 1, 2, 3, all the way down through year 10, and we get the $100 back in year 10. All right, what we're simply going to do is compute the present value of those cash flows, and we're going to do it at the yield to maturity. So go ahead and quickly get out your financial calculator and put 8 in your numerator. Put 8 in your numerator and divide by 1.085, and you'll get the 7.3733. And then to get the 679.56, just divide the 8 by 1.085 squared, and the cube, etc., etc. That's back here. Look at that formula there. And look at the denominator in the numerator. Can I say that? That sounds silly, right? Look at the denominator, 1 plus r raised to the t. So in this example here, t is 1, and then 2, and then 3, and then all the way up to 10. So if we sum that present value column, we get the price of the bond, 96.7193. Now, this is what you should be thinking. You should be thinking, wait a minute, Jim, you taught us in a previous learning module how to compute that price. So ready? Get your financial calculator. I'm not getting mine out. It's all the way over there. So let's do this. Do 10 and make that N. Do 8, make that payment. Do 100, make that future value. And 8.5, make that I and hit present value. And what do you get? Voila, as my mother used to say. I have no idea what that meant back when I was a little dude, nor do I know what it means today. But there you go, 96.7193. So the duration calculation will help us compute the price. Now, granted, we're computing the price the long way. All right, so then here's the interesting column over here that makes, let me go back here, that makes all this stuff here, compute the weight of each cash flow. That didn't sound like anything we wanted to do back in this slide. However, all we're going to do is take that first 7.3733 and divide it by the price. And we're going to do that each time, and we get the 762, the 703, 648, 597, and so on. Then let's take a deep breath. Then we're going to, well, look at that far right column. The time to receipt times the weight. And so all we're going to do is multiply 1 times 0762. And what do we get? Well, we get the 0762, of course. Then we're going to take 2 times 0703 and get the 14. And we're going to do that all the way down. And then when we add the columns together, we get the Macaulay duration of this bond. So look at the result down there. The investor waits 7.2 years on average. What did I say? It's a weighted average time to maturity. So if you look at this Excel spreadsheet, you can clearly understand why it's referred to as a weighted average. So we take the weight times time, and we sum those and we get 7.2. So weighted average time to maturity. It's also a measure of the sensitivity. It's a measure of interest rate risk. Now, here's the question that we have to answer here. And I'm not sure I can give you a good answer. You're going to have to decide this for yourself. I'm fairly confident. You can't ever be 100% confident because you don't know what the Institute is thinking on exam. But remember, the LOS asks us to calculate. So the Institute could give us a 10-year bond and you could go through all this stuff. I don't imagine the Institute would give you a 10-year bond. I don't have any memory of doing this 20 years ago when I went through the program. But if it gives you a 10-year bond, you can do this. Maybe 5 years, boy, that's a lot less cumbersome and time-consuming. 3 years, well, clearly you can do this. However, what did I say at the beginning of this slide deck? There is a shortcut equation, and there it is in the middle gray box. 1 plus R, that R is just the yield to maturity, N is time, and CR is the coupon rate. And so if you go ahead and look at the calculations there in the second gray box, you'll see that it comes out to be exactly 7.1966. So you can use this, dare I say, shortcut formula. So you're going to have to decide, on the exam, do you want to memorize this from the Excel spreadsheet standpoint, which is, let me go back here, which is, this flow chart, or do you want to just try to memorize that shortcut equation? It's up to you. I don't really have any good advice. You guys pick which one that you want to do. But I will say this. Notice in this shortcut formula, there's on the far right a minus lowercase t divided by an uppercase t. What this is an adjustment for the time it takes to receive that first coupon. So here in this example, what we assumed was that we bought the bond today and we received that first $8 1 year from today. Well, what if we don't buy the bond today? What if we buy it in 4 months or 6 months or 8 months? So when we buy the bond in 4 months or 6 months or 8 months, we're only going to have a certain number of days until we receive that $8. So we need to make some adjustments to reflect those number of days until the next coupon payments. And that's what that minus, in our case, it was 0 over 360. Now, the reason that we put this in a slide deck is because one of the 8 problems at the end of the learning module, they have a problem where it's, I can't remember, 120 days or something, which is what we did here. So let's do a different example here. 5 years to maturity, 1% annual coupon, 2% yield to maturity. So right away, coupon is 1, yield is 2. We know the bond sells at a discount. So look down at the bottom. There's the price, 95.9176. So let's go ahead and just redo the same. Here, let me go back here. So this was a simple one, right? Time to receipt was 1 year and 2 year and 3 year. But now our time to receipt, well, if we buy this bond 120 days into the first coupon, well, when we buy this, then there will be 240 days until we receive that first coupon. In this case, it's $1. So what is our time to receipt? It's 240 over 360, which is the 0.6667. And I'll say this right now, those of you who are old enough, I'm super uncomfortable with putting 3 6s on there. Those of you who ever watched that old movie, Damien the Omen, you'll know what I'm talking about. All right, everything else is the same. You do the present value, you do the weight, multiply, and there's the duration of this bond, 4.56. If you want to go ahead and use the formula, the shortcut formula, there you do. You get the same answer. So once again, make sure that you choose which method that you want to memorize for the exam, because this sounds like a great question. I make my students do this every semester in the investments class. I even make them do in derivative securities when we have a bond, we own a bond and we want to use a futures contract and we want to hedge. So we're worried about investment horizon. We're worried about using a futures contract to, kind of change the duration of the bond, et cetera, et cetera. So this is super important stuff. From a test creator standpoint, I imagine the Institute is probably thinking along the same lines. Now, let me go ahead and warn you that if the Institute says something like this, the second diamond point there, assume 120 days, make certain that you're aware that one of the choices, A, B, or C, will be, it seems likely to me, will be the duration on an annual basis. So don't make that mistake, is put the annual duration on there. Make sure you adjust it, either by the subtracting the T over T or by the time to receipt column here on this. All right, so this is a summary page of exactly what I have been talking about, which is why I gave you that example at the very beginning. Provides insight into the bond's interest rate risk. Now, the reason that we don't say it provides complete insight is because we have this other concept. This is called convexity. I'll go ahead and warn you that duration is a first derivative, and so therefore it has a fixed slope. But convexity is the change in the slope, which isn't impacted, is not realized by the measure of duration. So in a future learning module, we're going to combine duration and convexity to get a complete insight into interest rate risk. So look at the bottom dolphin point there. Higher Macaulay duration, greater interest rate risk, greater sensitivity. Look in the top right, there's the dollar sign. Investment horizon matches duration. We're going to call that the bond is immunized against interest rate risk. So notice what the Institute is very careful to say it's nearly hedged. And that's why I was telling you about the parallel shift either upward or downwards in the yield curve. If there are some kinds of shifts, and by the way, spot curves, par curves, forward curves, they almost never have parallel shifts. But they have nearly parallel shifts. So this concept of immunization is super important. So there you go. It takes us through these 3 learning outcome statements. Boy, I had super fun doing this one. I could talk about duration and convexity for 100 years and I would never get tired of it. So I want you to go to the end of this learning module. There are 8 questions there. You ought to be able to do those in 10 minutes or so, depending on how long it takes you to work through the Macaulay duration question. But those things there, they emphasize interest rate risk and price risk. And now they won't use the term immunization, but they'll tell you about investment horizon and duration. So hey, thanks for watching. Have a great day and good luck studying.